Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Monday, March 7th, 2022. It's 10:07 Eastern Time as I'm starting the video, and what I'll do in this one is a brief update on the equity markets, and then I just want to speak to some of the other things that are moving recently, give you my thoughts on those. Had some questions put to me recently in the comments under some of the recent posts, so I'll just give you my thoughts on crude oil, wheat, palladium. Somebody asked about the fertilizer stocks. And then so I'm going to give you my thoughts there more so than really go through the charts. And then I do want to do an update on the financial sector, look at the financial stocks, and the semiconductors. So we'll look at those. Let me just scratch that down here. That was in my mental notes, and now it's on my notepad to cover. Okay, this is a chart I got out to you this morning. Do my best to try to thread the needle. It's not always easy to, figure out all the zigs and zags, but, my thoughts were pretty clear this morning. It's a counter trend bounce, and you got to take those. We had about a 2% counter trend rally this morning off this morning's lows, even in the early pre-market session, QQQ, but especially in the stock futures, which were down about 2% or so last night and early this morning, and then recovered that. And we even had the Nasdaq 100 open green today. So that was there's the level right there. We were right here in pre-market, the top of those white. That's what the white lines. You probably can't see it there, but there's a shaded box here, and that shows you the pre-market session there. So we were right there, really right about where we closed Friday. That's where we recovered back to. Again, that was earlier today, and this is. Let me grab the current chart for you. See where we're at. So there it is. I had those lines still turned on. So you can see a nice fade. So that was a timely short. Now, look, the day's not over, but even for a quick trade, if nothing else, you can see here's a 1-minute chart. So right here, this has the after-hour trades turned off. That was yesterday's close, right? Or Friday's close right there. Market open pop. That's where I got that post out to you. We were somewhere in here. And then so far, it's been good for, they faded this rally so far to the tune of about 1.65%, nearly all of it. So that's it. Basically, look, this is not rocket science, and there are no guarantees. One day, the correction or the rally or bear market, if that's what this is, still not technically that yet, but if that's what it is, then one day it'll be over, and then shorting the rips no longer works, or there's going to be counter trend rallies that are worth trading. Again, I love bear markets. The counter trend rallies, even positioned for several weeks or more, are just extremely profitable to trade, and also extremely profitable to sidestep if you're short to cover that. So I don't think we're there yet. My thoughts, but so up until then, I'll just throw out levels that seem objective. And, those arrows showed you this morning. I always draw the darker, brighter arrows of primary scenario, which had us reversing there. And then I use lighter arrows, well, typically for alternative scenarios. And we still could. Look, we could still hit that trend line. If we take it out, it's not the best defined trend line, but it's fairly well defined. It's not the be all end all, but ideally I want to see us stay below that trend line right now. And of course, I can't harp on it enough to see these recent lows get taken out. As I mentioned to this morning, we were about almost 6% above those lows. Let me measure it for you there. Yeah, 5.85% in the Nasdaq 100, and closer to about 5% or so, a little under in the S&P 500. So there's work to do. It's still anybody's game, but right now there's no evidence. We still have those divergent lows recently, I will say that. But other than that, that's just potential bullish development until we start taking out the previous reaction highs, which define a downtrend. We don't have any evidence that this market has bottomed. None whatsoever. Okay, and as I turn off those pre-market trades, so white lines went away, you can see we've now taken out, which was last week, pending the next sell or another objective short entry. Again, objective short entries can be a bounce back into resistance, which we did have some levels I showed you on the futures this morning. That's why I threw that out. Next big resistance on the Qs is really the intersecting downtrend line, that 341.50 level. But we had that minor support right here at about 334.74. We kissed it perfectly on Friday, right? Touched it, bounced, but the bounce so far has been muted and got sold into, and now we've taken it out. So that is, especially if we can get a solid 60-minute close on this candlestick below there, then that's going to be another check mark for the bears, and increase the odds we're going to go at those lows. And as I said before, I think if we even get close, we'll just probably pour on right through. I thought we'd get that impulsive drop last week and started out that way, but so far, they stepped in and bought up the futures on last week's low. But if they wipe that out, I think that's going to be, from a technical perspective, no, it'll be very bearish. Whether or not it was government intervention doesn't matter. Whoever government can commission the banks to support the market by buying futures. Somebody's got to hold those futures, and at some point somebody's got to sell those futures, and it's a big world out there. So if there's enough redemptions, there's a lot going on. I mean, so much I want to cover. I'm going to try to keep it semi-focused in this video. I keep telling you I'll work on getting shorter videos out. But one of the things among many, I've talked to you recently about the pension funds and how they're, just persistently underfunded. Sure, they made some headway in the last couple years with the Uber bull, the Fed injecting liquidity. But what they did, and you can almost count on them to do so. They're a lot. These are supposed to be some of the smartest and brightest people in the world as far as money managers running these. Something like CalPERS, these giant multi-billion-dollar pension funds, but they're just like the investing public, what they call the dumb money, retail investors. As stocks go up, instead of taking profits and reducing their equity exposure, this shows you the public pension equity allocation at the end of the year. They were at a multi-year high come the end of the year, and so it's just telling you they're getting clocked right now in the stock market, and then that's going to has a domino effect. It has repercussions. It's not just, okay, well, that pension fund's down, then they have to start squeezing state and local government budgets. Those pension benefits are guaranteed to be paid. They got to be paid out. So then the workers that are currently working, they have to pay a higher share. The municipalities have to raise taxes and take away from other resources, whether it's police department, teachers, whatever. So anyways, this is all what I talk about, and why I see the potential for a very quick swoon down, because the fundamental landscape can and often does change so rapidly. Those pimple-faced rookies coming out of college or with their MBAs and working as analysts at the big firms, they just don't get the intricacies here of simply a falling stock market as the technicals predicted, and then these other things come together, and it's playing out, and then one thing leads to another. In other words, when these U.S. When the pension funds need to, and not just those, but a lot of others, they need to reduce risk at this point. They can't sit there and use the hope and pray strategy that some investors do, where they bury their head in the sand. No. They have a fiduciary responsibility. They could face certainly lose their license, and if not worse, by being reckless with these funds. So in a rapidly shifting environment, they're going to have to do what? Are they going to boost their equity holdings? They're already at multi-year highs? No, they need to reduce it. And then the domino effect on the market, and that's why corrections, especially bear markets, happen so fast. And again, I say it all, that's why I love to trade them. So what I noticed today, a couple things that stand out to me is the big FANG stocks are down, most of them more than the index. Let me go back to QQQ real quick. And these are things I watch for. And what does that tell me? Well, that's institutional selling, because they are the ones chock full of those. These are the top weighted components. So you have the Qs down 1.52%. Apple still, best of the breed right there, but still, it'll eventually succumb to forced selling, forced liquidation. But you can see Microsoft down 3%, Alphabet down 2.6%, Amazon down 2.9% right there. So a lot going on there. Tesla's bucking the trend today as of now. But then we're going to look at semis in this video as well. The two sectors I want to highlight are really the financials and the semiconductors, because those are two that I've talked on as short trade ideas recently. Okay, before I get into those charts, and it won't be a very long video, maybe another 10 minutes. I just want to comment on this because I've had questions. I had questions put to me about crude oil, questions put to me in just one of the recent posts about fertilizer stocks, and of course there's wheat, things like this. So this was my reply. You can read it, but again, I'm staying clear of those because fundamentals. You know me, I'm a purist. I believe the charts often are more accurate predictor. I strongly believe that of where prices are headed. However, there are times when the fundamentals are either overwhelmingly bullish or bearish, and or the fundamental landscape is rapidly changing. Nobody can completely predict what's going to happen here, but what I can tell you with certainty is Russia is the world's third largest oil exporter, so that certainly has an impact. And I think I've read it was maybe 8% of our imports, or 12%. It was somewhere around there, around 8, 9, 10% last year was from Russia. It's not about the U.S. If we finally get the gumption to ban crude imports from Russia, it's our allies. The European countries are much more dependent on Russian oil and natural gas. But where I'm going with this is that is a extremely volatile. It's one thing, as a trader, an investor, you take risk. It's part of the game. You cannot avoid it. You can attempt to mitigate it. And right now, there's so much volatility in the markets and profits to be made in the markets, gold, silver, all those are my core positions. Short equities, long gold and silver. Everything else, I'll hit and run. You know me, I've been bullish commodities for years, calling for a new bull market in commodities a couple of years ago and reiterating that along the way. And also tactically, shorting pullbacks or going long for bounces. But at this point, again, Ukraine is one of the biggest exporters of wheat. And again, there's so many variables. It's not just the Russian invasion. Talk real quick on fertilizers. Russia's one of the largest exporters of fertilizers, things like potash and whatnot. And so it's going to affect crops globally, including the U.S. So again, it's just a huge wild card. What are we going to put restrictions on? What aren't we going to put restrictions on? Will Russia decide to stop selling it? So we don't know. And again, this is a crapshoot to me. It's going up, but I think the risks are just as big on the downside for some sudden government intervention, whether it's oil, whether it's grains, anything else. Again, it's a crapshoot. So I just want to let you know, for as of now, I was staying away. Now, tomorrow, next week, I may post a setup on wheat or crude oil. I'll show you levels on crude. I showed you some last week, and I'll continue to show you levels. But again, my preference is to stay away, so you're not going to see a lot of analysis until I feel more comfortable. To me, it's all about risk reward, not how much something's going up. It was like GameStop and AMC back then. I acknowledged what they were doing. I didn't touch them on the upside, but I waited, and then we shorted those stocks at the right time. And I can tell you right now, and again, this was in my comments, my next trade on crude oil and wheat will most likely be, as far as a swing trade, will probably be on the short side. But right now, there's no evidence. These guys have gone parabolic. That's wheat. That's what it looks like. USOs, the crude oil ETN, again, going parabolic. And there's just not a lot I see in the charts. I showed you before, last week, I think, some things on crude oil. Let me show you that right now, just to update it. There's an uptrend line right there. So it's walking its way in an uptrend line, and look what it did today. Put in a little divergent high. The divergence stayed. This was last night's trading. This was a 10% drop from the spike high in last night's Globex session. There it is, and it dropped about 11%. A perfect trade. I mean, right there, right to that perfect support. Look at that, two major reaction highs, and this one defined by a gap, and it backfilled the gap and it hit the trend line. So there's a bounce trade to be made, but these are just too quick and in and out kind of things. Again, if it breaks this trend line, yeah, probably come down more at some point. As I mentioned earlier today in that post I got out, we're going to see, and I believe it's already here, demand destruction, undoubtedly. With the surging crude prices, it's going to have an impact on the economy. Okay, so to wrap that up, we know Russia's a big crude exporter. Ukraine's a big wheat exporter. Russia's also one of the large, I believe, the second largest producer palladium. So you've got all kinds of things going on there, and the big crazy moves in those securities. And yeah, a lot of money to be made, but or a lot of money to be lost. When those, when the charts normalize and there's not such a wild card in the fundamentals, that's when I'll return my focus to those. Last but not least, I've been persistently and consistently bullish on gold, especially waiting for him. We got that breakout, and gold's done nothing but go up. And I wanted to mention this, not just to harp on that, hey, it's, great breakout, follow through everything that, I was expecting and wanted to see and have seen so far. More so, I wanted to mention that somebody had made mention in the comments section, one of those posts from, I guess, Friday, at the euro's tanking. And I always talk about, and I usually include the euro in the dollar in my analysis. You guys, if you followed me for years, you know that. I always say analysis on gold was incomplete without analysis on the US dollar or the euro. But I also say, I'm not a current forex trader. I track the currencies mainly to help align my analysis on gold. Now, the charts on gold are clearly bullish, as I just showed you, and I've been making the case for. And euro is sinking because they've got a mess going on over there. Okay, we're in better shape and more likely to raise rates faster. And so here's the takeaway is the impact of a rising or falling dollar against gold is nearly immutable. It is in a vacuum. If you froze supply and demand, equal number of buyers and sellers, there is a direct correlation. I say this often, I know you've heard me say it 100 times, between gold and the US dollar or the euro, which is inverse to the dollar, and that is dollar goes down, gold goes up, which gold and euro go up, and vice versa, right? And it's simple because the gold, at least the gold I'm trading at least in gold futures or GLD, and most of the way, a lot of times around the world, yeah, gold can be priced in euros and other currencies, but again, let's keep it simple. Gold being priced in US dollars means if the dollar rallies and it's strong, then it takes fewer dollars to buy an ounce of gold. So the price is going to go down. If the dollar falls, it's going to take more dollars to buy 1 ounce of gold, and the price of gold is going up. So right now, you would think that gold would be falling because of the falling euro, and same as a rising dollar, but it's not. And so to me, I find that uber bullish because the offset of a rising dollar and falling euro is being more than negated. Gold's going the other way, and it tells you simply there is an overwhelming demand because this impact of the currencies on gold is certainly a thing, but it can be offset again if you have a lot more people buying gold. So I shudder to think what would happen if all of a sudden we had a strong rally in the euro and drop in the dollar. That should be an added tailwind to gold prices. Even if there's some fundamental headway for gold, which there could be, some kind of, it's hard to imagine, but immediate resolution of what's going on over in Ukraine, something like that, where gold takes that flight to safety bid, which is finally kicking in. Talked about it for a long time. I kind of laughed how Wall Street had written it off. Most people had written off gold as a flight to safety asset because Bitcoin was here, and Bitcoin's the new gold, and we all know what happened there. So, all right, enough on that. Just wanted to mention that the FANGs are under pressure today, more so than the primary indexes. And then to take this thing home, the two sectors I wanted to mention to you today, cover our financials. I've had a yellow line here, really a zone, and we're starting to crack that zone. I got a price alert today. It's about $37 on XLF. We're not clearly below it yet, but you can see these two parallel lines right here, really a support zone. We had support right here. Then that support was broken. We went in a trading range, and support once broken becomes resistance, right? So all this was a very, very well-defined resistance. We popped that resistance. Resistance once broken becomes support. We had a little whipsaw through there, but it held support, tested, and held. So look at all these successful defenses of that support, and we're starting to crack. And so what's going on here? Well, historically, rising interest rates, especially of long term, are beneficial for banks. They want to see their margins are going to go up, but we're not seeing that. We're seeing things go the other way. We know short-term rates are going to go up, but the long-term rates, we're looking, the odds for that stagflation environment I talked about have increased now. Stagflation is where you have inflation in prices, but yet the economy is soft, or even in a recession. So you have contracting economic growth with rising prices, and that's a bad bugger for the economy. And so that's not going to be good for the banks if that happens. And also, what kind of exposure to these banks that have their hands in the cookie jar? We had 1929 happen because the banks were gaming the stock market and had people's money intertwined there, and the government separated that, Glass-Steagall Act, but then Glass-Steagall collapsed and was, taken away, and the banks are back to doing their, making a ton of profits, gaming the market. So how much exposure they have to Russia, that's all yet to be seen. And again, it's a sticky mess around just from the financial markets, everything we have going on. So, look, you can sit here and talk. I'm not telling you anything you don't know. All I can tell you is we've had these three divergent highs. That was the last divergent high there, and since then the financials have peaked. They really topped around here. That's when I was calling a top on them, and we hit my first target. And as I mentioned, we never exceeded a reasonable stop based on the short entry back here to where we went. We just went sideways after slightly marginal new high, and so this trade's still in play, technically, and I still think we'll hit my third target there. And so there it is. So if we can make a solid red close below this level right now, we're at 36.48 as I speak. That should open the door and most likely bring in some pretty powerful selling in the financials. And if they break, market's most likely going down as well. So there's my second and third targets still in play. This is a weekly chart, and I just want to rifle through some of the big banks and show you what's going on. So on a weekly perspective too, big divergent high, big negative divergence. PPO is still in positive territory. I look at the signal line, the white, last of the two to cross. All these red boxes show you when that happened. So when the boxes are not red, when you don't have these red boxes, it means the PPO signal line was above the zero line, and you want to be long and strong, right? But when the corrections happened, they were all identified by these crossovers, including when COVID hit, down into the with the PPO crossing down below the zero line. Well, it's certainly headed that way. It hasn't crossed yet. We're coming up. The first support level I have on the weekly is about $35 there. Probably get a little reaction, and then if and when that's broken, probably head down to my next target about 31.35. But now let's look at the big banks. I'm going in order of market cap. We're on weekly time frames again right here, and this just doesn't look good. This is just not good for the stock market. This is J.P. Morgan, the 800-pound gorilla in the room for financial institutions, the big boy. Had this trend line right here as this was a longer-term primary uptrend line. It was broken when COVID hit, and as I mentioned, I dubbed that Ursa Interruptus, where the Fed came in with the nuclear not just the Fed, D.C. as well, Washington also putting money in everybody's hand, the Fed putting it into the bank's hands and the stock market's hand. And so they were able to stave off what would have been most likely a much bigger, the beginning of a much more lasting bear market, but it was still took J.P. Morgan down 46%. And then we got back above the trend line briefly, but we did so with big divergence, just like we had negative divergence before that 46% drop. So there it is. We're coming off that divergent high, and look at this. Bam. That was a good support level right there. Shattered. 140.36. Uptrend line support. Broken and back tested with a rejection. I don't see much stopping JP Morgan until it gets to 119. If I'm correct, could counter trend bounce as long as it stays below that 140-ish level. Looks to me like this one has at least another 10% downside. I won't go through each and every one, just want to show you a common theme here. Negative divergence here, clear divergence on the weekly time frame too, guys. This is not, these are the big corrections come from divergent highs like this one on the weekly chart. There was a divergent high right there back in early 2018. Doesn't look like much here on this weekly chart because we're covering many years. That was a 33% drop in Bank of America. That one was a lot bigger, and this is our most recent divergent high, and it looks to me like the correction's only just begun, and then boom, we just took out, you can see my trend line here. This trend line comes off the lows and the COVID lows. It's in March of 2020. Got a couple reactions right here. You parked it on there last week, and now we're below there. Below the 200-day or 40-week moving averages as well, which are starting to roll over. Haven't turned down completely yet. Started to a little bit, but again, ugly looking chart. Unless you're a bear, then it could be a pretty chart, and I think you'll see another 8% or so before the first decent bounce in the financials. Berkshire looking better. This is the best looking of the lot. Of course, it's not a bank, but look at that big bearish rising wedge. And this one has yet to buckle. So, you might say, well, why short the strongest? Well, I think this one you could short here and at least swing it back to the bottom of the wedge. That's probably what's going to happen is those banks will hit their target when Berkshire comes down to the wedge, maybe an intra-week overshoot and then park on it, and eventually I think it'll break down. So here's my targets on Berkshire, 294 roughly, and then about 274, and there's your long-term primary uptrend line. Again, that like so many financials, they got a stay of execution due to all the money printing that went on at the time and the nuclear option the Fed and DC pulled. But then if you look at it this way, all right, strip all that away, this is what I see. I see a beautiful bearish rising wedge pattern, and that would project meaning the measured target would be just a rough estimate, the widest part of the wedge you take right there. Add that to where the wedge breaks down, and see that should bring you right around to that my 274 target. WFC, Wells Fargo, little broadening wedge pattern here, just starting to crack. Moving averages are starting to turn down. It took out the 200 days. Last time it took out the 200 days, which again on a weekly chart, guys, if I say they're 40-week moving averages, on a daily they're the 200-day moving averages. That's the last time you took them out, right when COVID was starting to grip the markets. And even if you waited to that point, to the crossover, cross down below, you were good for about a 57% profit on a short trade. Look at that little bear flagging action right there, broke down and just kept going. So that's what it looks like. And again, 40 weeks have been taken out. Now, let me say this. This is important. The week is young. Last week we parked right on them. We're parked right on the 40 weeks. And today is only Monday, and it's only 10:30 as I'm doing the video. So a lot can happen. That could be an intra-week break, and then it's not even a whipsaw, because you need to wait for a final weekly close to say what the weekly chart broke down. Other than that, it could be intra-week, and you also have that uptrend line right there. So this is what I'm looking at. A little more downside. That should take us down to about 43.17, and that's going to be about another 9%. So there's a common theme. I'm looking about 9%, give or take, on the financials, maybe 10. So you're looking at, if you want trade ideas, well, you can short XLF. You could buy the 2 or 3 time. The 3 times short financials FAZ, and that would juice up your returns, because if I'm correct, it's probably going to be a pretty swift move. And this is what you want to see on FAZ. Actually, on the daily chart, you want to see the more green candles, the better. I've talked about this. I came across another article this weekend. they try to put these three-time ETFs down, and I get it if you don't know when to trade them, but swing trade them. They say they're only for day traders, but again, if you catch the right trend, like this move or this move, where there's more green, much more green candles than red on the daily chart, that three-time leverage not only doesn't work against you, it works for you, and I've covered that quite a bit in the past. All right, so that's one trade idea there. There's FAS. Let's see. You can also see it looks like it's about to bust above this recent trading range. And again, just take, what did I say, 10? So I would say, because it probably happened fast, say 30%. You know, go in there. Once you get about 27, 26% profit, if you take it and pans out, then just set a trailing stop. Account for the 300% leverage. In other words, if you usually use a 5% trailing stop, then you got to use a 15% because this is three-time leverage. That's just an example there for you. The other one I like too is the semis. I mentioned this before. SOXX. Just seeing a lot of these individual semis. You know, they have potential there. Look at NVIDIA. It looks like a bullish falling wedge, and it could play out. However, we're below. This trend indicator is clearly below that purple line. That's what defines bull and bear trends. And remember, these were all corrections so far within a bull market. And that one right there, that correction was 28%. This correction, when we dipped over here, now it's not from the high to low where the crossover occurred, I'm just showing you the total correction was 44%. Those were bull market corrections. So if this one is the beginning of a bear market, here was the last, you want to call it a bear market, back here in NVIDIA in 2018 to 2019, the stock dropped 57%, ended with a nice divergent low. So just showing you that I could go through all the semis, but the bottom line is you look at the weekly chart. I laid this one out as a trade idea for you a few weeks back, and I gave you targets on SOXX, and I said you could use SOXS, which is the three-time leverage. This is SOXX, the one-time non-leverage. Don't know if you can make it out there. Two X's at the end. And then the one with the S at the end is the three-time inverse of this one. So that's negative 3 times or 300%. Again, this is the one time because it's going to track better. So I had a couple things I gave you. I had, well, first and foremost, let me just walk it down, then I'll wrap the video up here. You had a divergent high, number one, right? Big divergent high on the weekly chart, like almost everything else. You had a trend line that was taken out. You had the key 40-week moving averages also taken out. And in my last update, I told you we had a bear flag right there. There was an impulsive leg down. There was a flagpole. It measures down to my target right here, target zone of about roughly 385, give or take. The measured target comes in a little bit above that, but I think we'll exceed the measured target of the flag and hit that level. Like everything else, like the stock market, we have to take out the recent lows. We have the recent lows weren't a random low, they were support. We had a previous reaction low from there. We had quite a few reactions through there. So this is where I think we're going. And if it does happen, again, I think it'll happen pretty quick. But it's the, ball's in the bull's court. I'd put nothing above this government to step in to do whatever they can do to try to shore up the financial markets, including the stock market. So we'll see. But I'm a believer that, the charts are, and the fundamentals are ultimately going to take the market where it needs to go, regardless of any short-term manipulation or attempts to get in there. So, all right, guys, those are some of the sectors I like. And again, levels that I'm watching to add to those positions or increase the odds we're going to go down to again, this was my first target. I gave you this as just first support level, T1 and then T2 down here. And that would be, huge potential, because if my second target's hit, it's going to be about another 40% downside in the semis. And if I'm correct, and you use the three-time leverage SOXS, that should be well in excess of 120%, probably be 180% or more, depending again if and how and when we get there. If we bounce off T1, you consolidate for a while and then go down. That's not going to help. It's that consolidation, the back and forth, that works against those leverage ETFs. This kind of stuff here. This is when you want to own them. SOXL, the three-time long, would have done great in this trend. SOXX would have done great, and by I say great, would have vastly outperformed 3 times that 39% drop in the sector. And again, this is how corrections usually happen. They're usually straight, pretty straight down. This one took a little while there, but still got a 27% drop. And then last but not least, because I say this often, remember, 28, 27, 39. These were just simply corrections in one of the strongest bull markets in semis we've seen in decades, ever really. So they were not bear markets. You get a bear market, that's when you're talking usually a drop of well over 50% in the semiconductor sector. So just keep that in mind, and it sort of meshes with what I'm pointing at here, because if my second target's hit from the highs, that is going to be about a 51% drop. All right, let me wrap the video up here, get it out to you guys. This has been Randy Finney with the Right Side of the Chart. Have a great day.